To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
Hello friends, I am here today to discuss with you CA Final SFM May 23 question paper. Now if you look at the question paper, right, I would categorize it as slightly tougher on the tougher side. See, there are parts of it which always will look easy when you look at it in bits and pieces. But on overall basis in exam environment, I would slightly rate it on a tougher side. On a scale of 1 to 10, with 10 being the toughest and 1 being the easiest, I would rate it closer to 8. Okay, I won't say this is the toughest paper possible, but this is a tough paper because they have, obviously they made 1 or 2 mistakes. Then because there are 1 or 2 questions which they have twisted, and because 1 or 2 new concepts they have asked, or rather concepts they have asked which they have not asked for a long time or they have never asked. Right. So these are the reasons why which I would rate this question paper as 8 out of 10 on a scale of toughness. But as I said, none of these are, except for 1 or 2 questions, all these questions are straight from the past exam paper or study material or mock test or RTP or wherever. Right. If you are a OneFin student, on an 80 marks of practical questions, right, you would be easily able to attempt 75 marks very easily, 70 to 75 marks very easily without any problem. And balance 5 marks also you would be able to attempt, but I am saying on a the ease with which you would be able to attempt is 75 or so, 70 to 75. Reason being, we have solved every problem in the class. That's all. There is no other reason. We have solved every variety of problem that is available. We have solved it in our classes. Right. So let us have a look at the question paper, and then we can discuss each question or at detail or in some kind of a length. Now, the first question, this is a question from M&A and Corporate Restructuring chapter. Let us see. High Growth Limited was having excellent growth over certain years. The board is considering a buyback proposal. The premium is to paid by raising a loan. The company has current market cap, EPS, PE. Post buyback price is so much, loan can be availed at an interest rate of so much, tax rate is 30%. The interest amount which can be paid for availing the bank loan is how much, calculate the loan to be raised, buyback premium per share. Right, now this is the first question, compulsory question, part 1, 10 marks. Now this is I think almost same to same as question number 37 from our OneFin material. I will actually show you the question as well. I think it is actually from July 21 old syllabus question paper. Let me just show you that. So here I have on the screen illustration 37 July 21 old syllabus. SM Limited has market cap of so and so, current EPS is so and so, PE is so and so. The board expects post buyback price to be so and so. Post buyback the PE will remain same. The company proposed to fund the buyback using a bank loan. Income tax rate is 30%. The interest rate, you are required to calculate interest, the loan amount and the premium per share in percentage paid over the current market price. Very similar question. There is actually, except for the, obviously the numbers are different, but the question is very similar. So I don't think any of the, OneFin students would actually have had a problem in this particular question. It's a fairly simple one. There's nothing complicated in this. Coming back to the, the question paper, first one was a 10 marks question. I won't say it's a lollipop, but I definitely think it was on the easier side. Now coming to the second question, which is a 6 marks question. Now this is a very interesting question. This is from foreign exchange chapter, and this is very similar to question number 56. The first one was question number 37 M&A, and I am referring to SFM material, and here second one is Forex, question number 56 on OneFin material, right, Forex. Now this is a question again, Export Limited and EOU invoices in currency of importer. It expects a receipt of 2.4 lakhs on 1st August for the goods exported. The following information is available on 1st May. You have exchange rates for 1st May. And these are 1 month forward, 3 month forward, 1 month future and 3 month future, and the contract size is also given at 6.4 lakhs and initial margin. Now this initial margin, if you guys remember, this is a concept in currency exchange. It is not, or rather futures. It is not for your forward market. So this initial margin, what has to be put in, that is also given, and interest rates are also given at different points of time. On August 1st, the spot rate is so and so and the currency future rate is so and so. Suggest a suitable approach to export limited that would be most advantageous out of the following methods: forward contract, currency futures, or no hedge. Assume the variation in margin would be settled on maturity. So we learned that margin variations will be you'll have MTM on a daily basis. Here they said there is an assumption, right, that it will be settled on maturity. Now this is exactly like question number 56, which is page number 348 of the OneFin material. We can see here XYZ is an export oriented business entity based out of Mumbai, receipt of $1 lakh, and exchange rates for 3 periods are given, currency future rates are given, initial margin is given, interest rate is given. You are supposed to find out what would be most advantageous: forward rate, currency futures, or hedging currency risk. Which one is better? Not hedging currency risk, which one is better? Very simple question actually. This again, we've solved this in the class. I don't see any reason why this should be complicated. Some of you may get confused because of the indirect quote, direct quote, that concept, but I don't think that should be a problem for anyone who's actually listened through our classes. I don't think it should be a problem at all. Right, now let us go to the next one. This is theory question on what are swaptions, how can be done. So basically you take a option to enter into a swap, right? So that is what is a swaption. What are the other areas of its application, so on and so forth. Whenever you believe that you have a right to enter into an option for a fixed to floating or floating to fixed, depending on which way you think the interest rates go. So this is also again a fairly simple question. So that covers 20 marks. I think on this question, right, other than this forwards question where people may get confused, the first question was fairly simple. Right, now coming to question number 2A, which is, this is a question from risk management. Somebody is a rational risk taker. He takes a position in single stock for 4 days. He does not take a position on Friday. Then he desires to make a maximum investment where VAR should not exceed the minimum balance lying in his bank account, and the position by his manager as per standing instructions taken on free balance. On Monday morning, he has transferred an amount of 11 crores. Fixed deposit is also matured. Fixed deposit value is 63 lakhs. However, Mr. Bull received intimation on the same in the evening. That is what of the fixed deposit amount. But he got to know about it only in the evening. So for 4 days, you have 11 crores, whereas for 3 days, you have 11 crores plus 63 lakhs. The bank needs a minimum balance of 1000 at all time. Value of Z score at required confidence level of 99% is 2.33. Other information with respect to stocks X and Y which are in consideration is as under. You are required to recommend a single stock where maximum invest can be made. Okay, so now see, this question is very, very similar to question number 4 of OneFin material, and this was a very similar question was asked in November 20 new syllabus examination. However, one issue what they've, it's a poorly drafted question again. This is what I don't like about ICI, where they, eat some sentences or words in the questions. Right, here they should have asked, they said you are required to recommend a stock where maximum investment can be made. So what will you do? X and Y are there. Both of them have probabilities. You will multiply the return with the probability and arrive at a expected return. What have they said? You are required to recommend a single stock. So out of those two, you will recommend where maximum investment can be made. You will say, yeah, make the maximum investment. That's all. That's the answer to the question. Actually, theoretically, pure looking technically at the question, right? That's the answer. But that is incorrect. Actually, they should have asked one more line. What is maximum investment? They ate this line. Okay, so very unfair on institute's part. You are supposed to assume this and compute this. See, otherwise the question is only about this, which is expected probability. You are given VAR, you are given some numbers. Where will you use all of that? Only when you can figure out what is the maximum investment that can be made. Now, let me take you through this question in our OneFin's material. We have solved actually in the class. See this question. On Tuesday morning before opening, going through bank statement, he has 7 lakhs lying. It is available from Tuesday till Friday. Bank requires minimum 1000 VAR. Investor desires to make a maximum possible investment, so on and so forth. Right. Everything is very, very similar. Here, you are required to determine the maximum investment possible. They asked you that question. They specifically asked you that question. Now, in our case, they didn't ask. In May 23 exam paper, they didn't ask. That's very unfortunate, right? I mean, theoretically, right? If you answer the first part of the question, they should give you full marks. The first part of the question is what? Which is choose the stock. That there is no major logic in that. I mean, just multiply expected probability into expected return. Basically, multiply probability by return and you get the expected return, choose the stock. right? So very unfair on ICAI's part, which is what I don't think is appropriate. But anyway, we discussed this in the class. This is question number 4 from OneFin material. It is page number 49 if you are looking for it. Then coming to the next question, part B of 2. This is a question from security valuation equities, and I like this question. This is a good question. We have not solved a very similar question, but I think this is a good type of question. An investor is considering purchasing equity shares whose current market price is so and so. The company is proposing dividend of so and so, and the dividend is expected to grow 20% for the next 4 years. Thereafter, the growth over next 3 years will linearly decline by 100 basis points per annum. So it is 20, then 19, 18 and 17. So from 20, so for 6 years it is, 4 years it is 20, then 19, 18, 17. Okay. Thereafter, it will stabilize at a certain rate. So till infinity, it stabilizes at a certain rate. The required rate of return for the investor is 20%. Okay. Dividend value is to be taken in 2 decimal points, thankfully, to calculate the stable growth rate of alpha after the end of year 7. So 4 plus 3 is 7. So after 7 years, what is the stable growth rate? You basically have to backwork. So what is the formula for value of a share? D1 by 1 plus cost of equity power 1 plus D2 by so on and so forth up to till D7 by 1 plus KE power 7 plus P7, and P7 is D8 by KE minus G. You basically have to find out this G by substituting all these numbers. So you have the value of required rate of return is 20%. Here also required rate of return is 20%. This D8 value you will know. How you will know? You take that 6 rupees, grow it at 20% for 4 years, then grow it at 19, 18, 17 for 3 years, and then you will have some value. That value, it will grow by some percentage. That percent, so D7 into 1 plus G divided by KE minus G. So you have to equate this and backwork and the price is 172. So 172 is equal to P0, which is equal to present value of dividends plus P7, which is P7 here, divided by 1 plus KE whole power 7. So you have to again bring this backward. So P0 you already have as 172. This you will get a number, you will get some number. Here you will have to work, you will have to substitute this number here, substitute this number here, and then work out and work backward. So this, honestly, I actually think is a lengthy problem. There is a scope for mistakes and there is a scope for some amount of confusion because they've not, again, language is slightly nebulous, slightly confusing. So there could be a problem and it is lengthy. It is more irritating kind of a problem, not a very pleasing problem. So I think this is one aspect where you might have an issue, but again, it is nothing complicated. Even though we have not solved it in the class, I don't think there is any great logic in, this is a very, very simple concept. I don't see any major problem for anyone who's understood the concepts very well in solving this question. Okay, so this is question number 2B. Okay, it is new question, not difficult. Okay, now let us look at part C. Pay-through securities are in nature of participation certificates that enable investors to take a direct exposure. On the other hand, gives investors only a charge against security assets. Do you agree with this statement? Justify your stand. Pay-through certificates and pass-through certificates, we've discussed this in the class also. I've explained also. One of them is basically where you take direct exposure and, whatever comes in is passed on. Other one is, whatever money comes in is actually invested and only the returns are passed on. So there is some kind of predictability in cash flow. So we've discussed this. I don't think this should be a problem. You may get confused what is pass through, what is pay through. Just have a look. I don't think that is much of an issue, by the way. Next, coming to question 3A. This is a question on risk management. This is very, very similar to question number 21 of OneFin, and this is interest rate risk. Okay, previous one was, this one was slightly newish. Prior to that, 2A was risk management, question number 4 from OneFin material. Yeah, and I marked everything else. Okay, so if you look at this, right, there is what Indian firm has subsidiary in Singapore, SF, and SF, a Singapore firm has subsidiary in India. There are two companies, both of them have subsidiaries. Indian firm has subsidiary in Singapore and Singapore firm has subsidiary in India. So one wishes to borrow in rupees, one wishes to borrow in dollars, and then there is a requirement that, let me read out the question. The amount of loan required by both the companies is same at the current exchange rate. A bank arranges a swap and requires 50 basis points as its commission, which is to be shared equally. If means is a company, okay. If is the name of the company. Don't confuse it as if as a English language. If requires minimum gain of 20 basis points, SF requires minimum gain of 10 basis points for structuring the deal. The bank is very keen to structure even if it has to forego a part of its commission. So this is the keyword. So if they have to forego a part of the commission, see what is the total thing here. If is an Indian firm and SF is a Singapore firm. SF wishes to borrow in rupees. Okay, SF wishes to borrow this. And if wishes to borrow at SF wishes to borrow at a floating rate, SF wishes to borrow at a floating rate. This is wish, but this is what they want. And Indian firm wishes to borrow at a fixed rate. So this is wish, this is what they want. Yeah. So this is what ideally they want. But now the thing is, same party cannot borrow both. So obviously we have to look at case this or this. So in one case it will be B plus 4%, in the other case it will be B plus 4.5%. Now whether in this kind of a scenario any kind of thing is possible or not, yes, when both of them borrow at B plus 4 and B plus 4.5, there is a the overall cost is B plus 4 or B plus 4.5, so there is a difference of 0.5% that can be made gain technically. Now if this 0.5% is made, the INR company, if will borrow at this rate at BPLR plus 0.5, and where is it, if wishes to borrow at fixed rate. So if will borrow at a floating rate and then swap it out to fixed, and SF will borrow at a fixed rate and swap it out to floating. So they will ideally get the overall cost will be B plus 4. The overall saving will be 0.5. This 0.5 will have to be split between both of them. If requires minimum of 20 and SF requires 10, so basically 30 gain is gone, so 0.2 is left. So the bank is very keen. So out of the 50 basis points, if they are very keen, they will reduce the commission. So they will reduce the commission from 50 to 0.2. Right. Now whether there are advantages available, yes. Whether a swap can be arranged, yes. The rate of interest rate that they will end up paying, I just computed it and showed it to you. It's a fairly simple one. And anything else? See the funny part, they have not even said how much money, they have not even asked how many dollars, how many rupees, kuch nahi, just discussion, and it's an 8-mark question. Only if you understand this logic, we discussed this in the class, B plus 4 and B plus 4.5, what is the differential, if anything is possible or not, that's all you have to look at. Some people will add these two, some people will add these two, all that is wrong. You have to always add cross. I have told you also multiple times and I have explained it in detail. Now this is very, very similar to question number 21 in our material, what I said. Question number 406, page number 406, question number 21, interest rate management. So BPLR plus 2, BPLR plus 0.5 and 2.25, BPLR plus 2.5 and 2. So one of them, obviously is possible. Yes, swap is possible. Who will pay how much? All of that discussion is there. This is very, very similar question, question number 21. There is nothing complicated. We have discussed this in depth, and this is also from past exam. So you see friends, how many questions have been asked from past exam? So far we have come across 1, 2, 3. This is the third question that is coming from past exam paper, which is why it is very, very important. And this one is 20. Previously we saw one more in 20, then we saw one of 21, which is why I keep saying last 3 years, exam papers are very, very important. For this reason only, 3 years, 6 papers are very, very important. Anyway, let's move back. Look at question number 3b. This is a question on derivatives. This is Mr. V is a commodity trader in rice trading. He has 24,000 kg. Following details are available. Spot price is so much. 3-month trading price is so much. Expected lower price after 3 months. Contract size is so much. You are requested to advise Mr. V how to mitigate the risk, how to use the futures price. What will be the effective realized price for his sales if after 3 months spot price is 69, 3 months future contract price is so and so. Very, very simple. This is question number 24, derivatives, futures, and this is again from study material, by the way. This is also a study material question, and this is page number 303 in our OneFin material. See here, question number 24. A rice trader has planned to sell 22,000 kg of rice. The spot price is so and so, after 3 months is so and so. What can trader do if he decides to use and what is the amount of price that is realized, right? That's what is the question. What is the specific question there? How to mitigate the risk, how to use futures, what will be the effective realized price if after 3 months spot price is 69 and in 3 months future contract price is so and so. Almost, I mean, ditto, right? And this is from where? This is actually a question from your study material. Okay, which is why it is very important to also solve study material. This entire question paper, right? I think we have had 2 new questions or 2 questions with twists, but other than that, every question is either from study material, past exam paper, or practice manual. However, there are twists in each question. There is a slight variation, there is a slight correction, or a slight modification, which may make it tougher. Which is why I think on an overall basis, I rank this particular paper as 8 out of 10. Coming back. What makes an organization financially sustainable? Wow, I have discussed this, I have done a demo video, I have done a revision video on this also. Okay, so I am not going to get into that. Now coming to question 4. 4A, this is security valuation, bonds, and this could be a twisted question. Okay, this is similar to question number 13 and 14 in OneFin. Okay, there is also very similar stuff in study material. Let us see what it is. An investor in the beginning of 22 purchased substantial number of 8-year 7.5% bond with 5% premium on maturity at required yield of 8.5. However, due to the continuing war in Europe, inflation is running very high in the economies of the country. Inflation is high. The yield on the bonds is decreasing. So actually this is an incorrect statement. When there is higher inflation, inflation rate increases, so interest rates are increased. When interest rates increase, the price of the bond falls, okay, and the YTM increases. Yields, market rates increase, so yield increases. When interest rates increase, bond prices fall. So this statement, no, the yield on the bonds is decreasing is a very, I don't know what to say. Especially when you're using the words like yield, no, you should be very careful. What they probably refer by yield on the bonds is the expected return of 8.5, what the investor was expecting. You may not get 8.5, the 8.5 is coming down, probably he is going to get 5, 6 or 7. That is the interpretation. But then using a word like yield as if it's a key word, it's a specialized word that you have to use in context. You cannot randomly use the word yield to mean something else when you're talking about YTM. So this is again unfair on ICA's part. The risk-averse investor wants to protect himself from further loss. See, that's what I said. Price is falling down, so his expected return is going to come down. And decides to sell the bonds in 23. He has got a proposal from another investor who is willing to purchase the bonds by shelling out a maximum of 797. He purchased at what rate? We don't know. I think he purchased at 8.5% return. So probably that is the YTM at which he purchased. Okay. He purchased when the price as indicated by a YTM of 8.5, whatever it was, he purchased at that rate. Now, in the market, it is going on at 797. What is the question? He follows intrinsic value. You are required to determine market price, duration, volatility. Will it be right decision for the new investor if he is looking for required yield to maturity as 12%? So now, what this means is, you have to check this implies what yield? This implies a yield of 11, 12, 13, I don't know. Rates have gone up, right? So you have to find out this number. What is the price at 797.5? What is the yield? And then you have to answer this question. Whether if he is looking for 12, is he going to get more than 12 at that price or less than 12 at that price? So this question, I think given the way it is worded and the way they have structured it, I think it's a poorly worded question, but a good question nevertheless. I mean, they could have done it better. As always, there is scope for improvement. Now, these are question number 13 and 14 from OneFin material. See here. Question number 13, face value so much, coupon, YTM and yield is given. Calculate the duration volatility of the bond, calculate the expert market price if required yield is 75 basis points. So that is not relevant, but typically the rest of the stuff is there. And then you look at 14, calculate current price, duration, volatility and so on. So the first 3 aspects are very, very common. Okay, so it is I wouldn't say that it is a completely new kind of question, but I think that, if somebody has gone through all these questions, I don't see any reason why they should, struggle a lot. Obviously, there is a twist. I'm not denying that twist, which is why, again, I keep coming back and saying this paper is, on the face of it looks easy, but then in exam conditions, for accounting for all these twists and all that, probably some students may get unnecessarily, disturbed or unnecessarily scared or tensed, which is what will cause the problem. Which is why I stick to my number of 8 out of 10 on a scale difficulty level. Yeah. So now come to the next one. This is for question number 4B, which is basically from Forex. And this is question number 35 in OneFin. Now, is this a very similar question? Let me see. Yeah, this is a very similar question. Hopeful Limited, Indian MNC is executing a plant in Nepal. It has raised 400 billion. Half of the amount will be required after 6 months. Hopeful is looking for an opportunity to invest this amount for a period of 6 months. It is considering following options: UK index fund or Europe treasury bills. They have raised the money in what? Rupees billion. Please note. And here the amounts are given in what? GBP INR and Euro INR. Okay, you have to note these two also. So interest rates are also very, very important. Okay, now if you invest in the GBP based index fund, what is the dividend you will get? What is income from stock lending? And what is the discount or investment or value at the end? Okay, basically how much will you get it back? What is the current spot? What is the 6 month forward? So how much will you, at what rate will you invest? At what rate will you get back? You will be able to know that. Then Europe also, there is an interest rate of 7.8% per annum. Investment value, what is the return value of the exchange rate, and 7.8%, what is the yield that you will get. You are supposed to compare these both. As an investment manager, advise the best option. This is how many marks? This is 7 marks. This again is a very simple question. We solved this question in the classroom, and this is also, not such a complicated question in my opinion. So this is question number, as I said, 35, which is page number 340 in our book. Treasury desk of a global bank in UK wants to invest 200 million for a period of 6 months. The equity desk in Japan wants to invest in high dividend yielding Japanese securities that would earn a dividend. The dividends are declared and paid. Post the dividend, securities are expected to quote at a 2% discount. The desk also plans to earn JPY on a stock lending activity. The securities are to be sold with a T+1 settlement. Fixed income desk is proposed that GSEC provides a return of 5%. Exchange rates are given. As a treasurer, you are advised to invest what is the best option, and is from MTP May 20. Again, I am coming back last 3 years, RTP, MTP, question papers and study material. If you solve all of these, 70 to 80 or even 90 in this particular question paper, I think about out of 80 marks, 70 marks you could have answered. Okay, so this is a question on, this is what question? 4B, right? 4B, and this is also from MTP 20. MTP May 20. Okay. Now let us move to the next one. Personal financing is one of the innovative ways. One of the innovators to finance a startup. Discuss 4 other methods. It's very simple. Bootstrapping, invoice discounting, vendor financing, bunch of other things. You can actually discuss this. Now looking at question 5A. This is very, very similar to question number 22 in mutual funds chapter in OneFin material. Okay, in our book. This is page 248, and this is also November 20 new syllabus question paper. Wow, this question paper looks like November 20 question paper. There are 3 questions from that paper. Okay, this question also actually had an issue, right? So let us read this question. An AMC on 1/4/18 had floated 2 schemes, dividend reinvestment plan and bonus plan. X, an investor, is invested in both the schemes. So he is invested. Mr. X, while submitting tax papers, claimed a capital loss on both plans, and tax officials, suspicion on the claim of Mr. X, decided to launch an investigation. Were able to collect the following details except the issue price. In this, when I did a review of the November 20 paper also, right, I had a very, very clear point in this that they have goofed up. What they have goofed up, typically in a mutual fund, because the mutual fund is going to invest the money that the unit holders are going to give it, on day 0, the NAV of the value of the investment, value of the money that is put into the mutual fund is going to be the same as the NAV of the fund, or NAV may actually be lower. So let us say I put 10 rupees into the mutual fund on day 0, right? The NAV may either be 10 or most likely it will be 9.95. Why? Because some expenses already been incurred, right? So to that extent, the NAV will, the issue price and NAV will be very, very close. NAV most likely will be lower. What are they saying? They are saying you invested and we don't know what the issue price is. How can that be possible? No mutual funds issues at higher than face value. What is the face value? They have mentioned also. Assume face value of unit as 10. If face value is 10, why will anyone issue it at 46? So basically what I was saying is, I will give you money of 10 rupees. You will go and invest the 10 rupees in 10 stocks. But the value of the 10 rupees is 46. Moment I give it to you from 10 rupees, it already has become 46. How is it possible? This is illogical. This is what I don't like from the, what the way institute has done. They've just copy pasted the problem of November 20 and changed certain data points, paragraph. In fact, if you look at the question, it is ditto. Very, very unfair on institute's part. Anyway, so this question, no, you have to assume a value of x here, okay, and value of y. You have to assume a value of x and value of y, and then keep working on all of these. You know, on x there is a dividend of 12%, then there is a dividend of 10%, there is a dividend of 15%, like that, so on and so forth. Then assume all the values, then work backwards and arrive at the value of x and arrive at the value of y. It is a, you know, it's a fairly, there is amount of work involved. And they've also given additional things. Investment is, they invested 10,80,000 in one plan and 10 lakh in another plan. So we don't know the number. See, face value of units is 10, 10 lakh 80 by 10 will be 10800. That's all. But they're saying it is not the face value, there is an issue price. Issue price is something else. Issue price is not 10, it may be 20, 30, 40, whatever, I don't know. Right, you have to find out. So that is not fair, and they've given average profit and average yield. So what is average profit? Average profit is over this many years, from 2018 to 23. How many years? 19, 20, 21, 22, 23, 5 years. Over 5 years, they earned a profit of 1,21,000. So for each year, average profit. So for 5 years. So for total profit is 5 into that. That is the total profit, and that they've earned. You know, on the closing date, the value is 80. So the total value of the investment made is 10 lakh 80. 10 lakh 80 plus 1.2 into 5 is 6.5 lakhs. So 16.5 lakhs is the value here. Okay. So what is the value here? Okay, so it's a, and after paying off certain dividends. So even though some money was coming in, you please have to note that this profit includes even the dividends that have been received in each of the years. So you have to adjust for dividend and arrive at it. We have solved this problem. You have solved this problem. It is nothing complex. I'll actually take you through this problem. This, what did I say it was? 22, page number 248. See here. Question mark, question mark. Here it is 1:4. In question paper it is 1:5. Here it is 12, same. Then 10, same. I mean, thoda the effort maro yaar. I mean, I feel very hard for the institute. Copying a previous exam question and putting it in this exam is no great, no great shakes, right? Anyone can do it. 49, 45, 50, 44, 42. So they've done same thing. Again, average profit they've given some number, average yield they've given some number here. So this is, as I said, you know, this particular question could have been drafted better. The institute has repeated the same mistake what it did in the November 20 exam also. Okay. Now coming back. Question number 5B. What is 5B? Mr. Potential has made investments in 2 mutual funds. The following information is available. Jensen's Alpha, Smart Fund, Growth Fund. For each of the funds, you have Jensen's Alpha, tenor ratio, actual return, risk premium. If you remember, Jensen Alpha is expected return. What is the expected return? Actual return minus expected return. Actual return minus expected return. So what is tenor's ratio? Tenor ratio is expected return minus risk-free rate by beta. Right, you already have actual return here. You have to substitute all the numbers in the formula and compute. See, this is actually, if you honestly ask me, this is not a complicated question. Just that you should know the formula there. If you don't know the formula, everything is gone. Right? If you don't know the formula, everything is gone. So this is from, you know, I don't know, the student has written something. I don't know whether this is the correct answer or not. I'll probably do a separate solution, you know, video. But this is just a video for you to go through the problems and all that, right? So that is a, you know, this is a fairly, and security, this is the part in this entire question. What is the security market line? Now, security market line is basically the beta formula bus. You know, whatever is the formula for expected return is equal to risk-free rate plus beta into return of the market minus risk-free rate. So, security market line. Actually, there's a question even in the material in what we solved. This is like question number 21, portfolio management, 1fin material, and this is from SM also. Even study material has something. Page number is 196. Let me open that. So you see, you require derive security market line. Security market line is risk-free rate plus beta into your risk premium. You're supposed to just find that out. That's all. Okay, so this is not a complicated question, but if you forgot what is security market line, gone, right? So if you remember, we discussed the CAL, CML, then security market line, all of that. Okay, so if you don't get confused, you're through, right? But in exam conditions, I don't know, some of you may get confused with something this is new, but this, if you honestly ask me, right, it is a simple question. Even if you forget this last part, I don't think how many marks is this, 8 marks, so probably you would have lost 2 or 3 marks. You can compute the beta and compute the risk-free rate. It should not be much of a problem, right? Then a limited partnership entity in India is not recognized for purpose of venture capital. Do you agree? Briefly explain the structure of venture capital in India. We've again, this has been explained in this chapter. I will not get into the details. Next, 6A. 6A is a question from corporate restructuring. M&A and corporate restructuring. In OneFin material, it is question number 13. It is also there in the study material, or similar questions are there in the study material. Some modifications made, but I don't think it's too difficult. What is it? It's a company is enjoying PE ratio of so and so. The total number of shares is so and so. It is proposed to acquire an unlisted company by issuing shares in the ratio of 4:5. That is, for 5 shares of SPL, 4 shares of BL. So you for 5 shares of the other party, you will issuing basically 4 shares. I discussed this at length in the class. What do you mean by this? The outstanding shares of SPL are 50,000. SPL will be listed before the actual merger to discover its value. The EPS of the merged entity will be so and so. No other information is available. You are required to calculate pre-merger EPS, expected market price, and number of shares of BL to be issued to SPL if pre-merger EPS of BL is to be maintained. So here they are trying to maintain the pre-merger EPS, not necessarily the price or P ratio. They've given the EPS already. They've given, no, right? So the number of shares to be issued if pre-merger EPS of BL has to be maintained. So this, as I said, is a question number 13 from our material what we've solved in the class. This is page number 468 of our OneFin book. What is the pre-merger EPS? If the PE ratio is so and so, what is the current market price? What should be the exchange ratio? Here there are some slightly additional points, like what should be exchange ratio if pre-merger and post-merger EPS are supposed to be same. Here, whereas in our question they themselves have said that what have they said? The exact wording was what? Number of shares if pre-merger number of shares to be issued. See, same question. What should be the exchange ratio if pre-merger and post-merger has to be same? Here also in our question also they have said number of shares to be issued if pre-merger EPS of BL is to be maintained. Same question, right? So I don't think this particular question was in any way complex. I don't see any reason why it should have been tough. This is a fairly simple question. There is nothing complex. This chapter, entire M&A chapter, is only about format mein putting things one by one in order, nothing else. Okay, now coming back to the last question, part B, question 6, part B. Now this again is a goof up, man, from institute side. Okay, an investor is proposing to invest 10,000 in 2 portfolios of A and B in the ratio of 3:2. The portfolios have 3 securities with following weights. So this is portfolio, this is security, right? There is weight X, Y and Z are 3 securities. Okay, now first question, calculate the weight of each stock. So now if you are going to invest in the ratio of 3:2, right? So 10,000 mein 3 times is 6K, 10,000 mein 2 times is 4K. The 6K is invested as 0.3, 0.25 and 0.45. So 6 into 0.3 is 1800 and 4 into 0.2 is 800. So 2600 is the first one. Like that you compute for the second one, you compute for the third one, and you will get the numbers, and you can say weight of each stock. So out of 10,000, the first one is 0.26. Like that you can compute with the other two also. Very simple. Now comes the second part. Calculate the amount allocated to B and C. Beech mein C kahan se aa gaya? Who is this C? There are portfolios called A and B. They could have at least said allocated to A and B. That is also incorrect. They should have actually said calculate the amount allocated to Y and Z if half of the funds are allocated to X. That should have been the ideal question. They have copied it from somewhere. Where have they copied? This is question number 31 from study material. Okay, this is question number 31 from study material. This is about that critical line. This again in another concept that they have not explained in current syllabus, but it is taken from previous old practice manual and they have asked a question. So even in current study material, no, this question is there, but the concept is not there. Okay, so I find it very odd. Okay. Anyway, so it is fairly simple. There is nothing complex in this. Just by looking at it, you can say the basic premise of this particular question, or rather solution, what you look at it is when X, Y and Z are corner portfolio, or when A and B are 2 portfolios which have stocks X, Y and Z, and they are lying on this efficient frontier, there is a linear relationship between these 2 portfolios such a way that A, B, there are 2 securities, right? X, Y, Z. There are 2 ratios. In X, Y, Z are in ratio, 1 ratio in portfolio A, 1 ratio in B. If this is going up and this is going up, then they should go down. Now, this is going up, there is a direct relation to how much this will go up. And there is a direct relationship between if this goes up, how much this should come down. That is visible. If 0.3 is going to 0.2, this is increasing from, if this is decreasing, this is increasing. Right, 0.25 to 0.45. So now what have they said? They have said if half of the funds are allocated to X, so X, this security is now 0.5. If half is allocated to this, this is going up, then this will come down. How much will it come down? You have to figure out. Direct relationship is nothing complex. It is just simple ratio proportion. You can actually do it by simple ratio proportion. There is nothing complex. And if this is going up, see, you see here in first case 0.3 to 0.2, so 0.45 to 0.35. So if 0.3 goes up to 0.5, this will also go up by something, that's all. But then again, the material has not explained it in depth, so I don't see much of a problem in this. But anyway, this is one question that, you know, especially the second part, if they see, the point is they've also not asked to use critical line method, or they've not said corner portfolio, or they've not said shorting, they've not said anything. They've just said if you are allocating 50% to portfolio, the security X, how much you will allocate to Y and Z? How will you tell it without actually explaining this? You have to use the words, correct words. So I actually feel bad for the students. And on top of that, they made a mistake. They used B and C when they should have used Y and Z. I don't know whether they'll give marks or not give marks, or whether they'll give free marks to everybody. I'm not aware of that. It depends on what the examination department does. But again, this could potentially be a tough question, the last part especially, because it is confusing. But anyway, you can get 4 marks here straight away. And what is the last question? Commodity characteristic express defines feasible commodities for trading derivatives based on exclusive list of required commodity attributes. What are the required attributes? So it has to be, store, tradable, there are a bunch of things. Index funds is one of the special funds. What are the other funds in special funds category? This also we have discussed it in, mutual funds chapter. So this is also a fairly simple question. So on overall basis, right? Overall, 8 out of 10. Okay. 3 questions from November 20. Then almost all questions out of 6 into 2, 12 questions, right? Out of 12, I think 10 questions, SM, study material is 1, 2, 3, 4, 5, 5 questions from study material, practice manual 1 question, then MTP 1 question, November 20 exam 3 questions, July 21 1 question, so 5, 6, 7, 8, 9, 10, 11, 1 question possibly is new, which is basically the security valuation wala question, where you find out the future growth rate, right? So total 12 questions, this is the breakup, right? So friends, my suggestion is, if you are a OneFin student, I would think that this question paper would not be very tough. Because we have solved all questions in the class. My suggestion is always go through, if you go through OneFin material, right, you have gone through RTP, you have gone through MTP, you have gone through study material, and you have gone through past papers. Why? Because I have taken everything from all these sources. There is no question that is left out. Everything has been considered. So if you go through OneFin material, which is some 500 odd questions, right, 500 to 550 questions, if you solve all of them, I can 100% assure you that nothing is left. Even if a new kind of question comes or some variation comes, it will probably 4 marks or 3 marks or something like that. 99% of everything is covered. Okay. Okay. So that's the conclusion. I wish you all the very best, and I expect that most of you would considering the way the question paper has been set, the upcoming batches would pay more attention to the material that we give. They pay more attention to the past papers, more attention to MTPs, RTPs, so on and so forth. Okay. Looking forward to see you all enroll. All the very best.